Hey everyone, me Kevin here. Boy, oh boy, it is time for an important update because look, people on YouTube like to claim that they're transparent and they tend to just be transparent about the good. I try to be transparent about the bad as well. I'm human, I make mistakes, and I want to provide some updates here about my startup. And it's not just going to be the good. We're going to talk about the downsides as well, some risk factors, and we're also going to talk about some strategies to make sure that we can really maximize our potential while minimizing our risks. But risks will never go away. So let's talk about those. The first and most important thing, and this isn't a mistake that has occurred yet or anything, it's just something that's becoming more and more evident to me on sort of a daily basis, is we need to be patient in this real estate market. Now, that doesn't sound very exciting to many folks because a lot of folks are regularly sending me emails or DMs or messaging me in Discord saying, hey, when are you going to buy your first property? Hey, here's a wedge deal. Go buy this property. Here's a fixer-upper. Oh, it's a good deal. It's this much below market value. And I have to keep telling people, look, we're probably not going to buy a single thing until at like the earliest Q2 of 2023. But honestly, probably Q3, Q4 of 2023. Like, we are going to be patient. And there's a real reason for that. See, in the United States, we have the 30-year fixed rate mortgage, which is the most popular mortgage for over 90% of home borrowers. And when mortgage rates rise, we don't actually really see the pain for existing homeowners for a while. It's really not until they lose their jobs and realize, crap, in order for me to move to get a different job in the event I had to move, I have to sell my house. Well, crap. Now I'm increasing inventory on the market. Like, it takes a while for you to see higher interest rates really affect the seller market in America. Whereas you look at countries like Sweden or Australia or New Zealand, where 2/3 of borrowers have variable rate loans and half of borrowers have to refinance this year or sell, you're going to see a faster housing crash than you are in America. And this is really important for when we look at America because, first of all, if the Federal Reserve were to U-turn tomorrow and say, that's it, we're dropping rates back to zero, the housing boom in America will just continue. Like, that'll be the bottom right there, and we'll just keep booming, right? Well, maybe we'll have seen an 8 or 12% decline, but it won't be very substantial. But the longer rates stay trending in the direction that they are, the more pricing will come into our favor. It's gotten so much so, and I've been talking about this since January on the channel, that now you've got companies like Invitation Homes who have realized this, and not only have they slowed or frozen their home purchases. Remember, they're a division of, well, they're their own company now, but they were started by BlackRock with the backing of BlackRock. They have 85,000 homes. They manage about 68 homes per employee, which honestly I think is pretty sad. Like, one employee could easily manage 2 to 3 times as many homes with the proper systems. But that's why I'm creating HouseHack, right? I believe with the systems that we have, we can operate substantially leaner and more efficiently, leading to higher margins and better profits and better growth for our investors. Now, but then again, Invitation Homes was created through the merger of many different companies over the last decade, and when you throw a lot of money at a problem, you tend to get a lot of inefficiencies. And so I don't know that there's necessarily that need to be very efficient at Invitation Homes, even though their stock is down 28%, they should probably start considering it. They are now looking to raise $1 billion in a joint venture partnership to raise more money to go buy the dip in single-family real estate, as the CEO is now saying, quote, we think there could be some even better buying opportunities, and that's why they're waiting right now. If we do see the market change in the way that's favorable to us, we can take advantage of that. That's why they're raising money now. It's the same reason I'm raising money. And, you know, that leads a lot of people to say things like, oh, Kevin, that means there's going to be a lot of competition. No, there won't be. Look, the home ownership rate during housing crashes, during housing recessions, declines. According to the National Association of Realtors, we're already in a housing recession. It's just a matter of time before we really start seeing the price declines. We've seen 6.5% already. Probably once we get to March to May of next year, we'll be down about 12 to 15%. And then how much further we decline really is just going to be dependent on the Fed. Are we going to get a small little discount, or are we going to start getting big Black Friday sales next year, right? And this is what we want to be prepared for. But because of that lag I've been talking about with how much longer it takes for the job market to really be affected in America, and then once the job market is affected, then we start seeing the pain of housing via more people having to dump their homes, whereas otherwise they would just stay put if they could. That's when we start seeing pain. See, The Economist notes that younger individuals who are actually more likely to move for a different job, they're the ones who have the least housing equity. In fact, we expect that a 15% drop in housing prices in America could destroy over 2/3 of the equity that homebuyers have who've bought in the last few years. Now, all of a sudden, you're starting to get to the level where you might very soon, once we have maybe a 20% decline in certain markets, especially like Boise, Idaho, or Florida, or Texas, you might start seeing people with negative equity. And that's when you start getting these potential short sales. Now, I'm not actually projecting that we'll have like a short sale foreclosure crisis. But my point of all this sort of market background talk is just to say that I need to be extremely patient, because remember, my reputation is on the line with HouseHack. Like, I'm 30 years old. I've been doing real estate for 11 and a half years. I want to keep doing real estate and being part of the investing community in Wall Street for the next 40 to 50 years. Like, I don't see myself stopping. I mean, think about it. 50 years, that's a long time. That's like, Warren Buffett's, 90 or something now, or maybe even older. I don't even know what he is. Maybe he's almost 90. I don't know. But the point is, if I'm 30 plus 50, that's 80, right? Hopefully, knock on wood, I'm still going. And I plan to, because this is just part of my life. I like traveling to look at real estate. I like getting ready to buy real estate, and I like buying real estate. I like remodeling real estate. I love dealing with tenants. It's great. But the issue is that we face right now is the potential of being impatient. I mean, today, you can already, as a fund, like what we have, or a corporation that's raised money via a fund, we've raised over $29 million of commitments. We'll talk more about that in just a moment. We could buy bulk homes from home builders today at 15 to 25% discounts, depending on how we negotiate, which is really remarkable. But why would I do that now if I expect home prices to fall 20%? And then I could get another 20% discount buying in bulk on top of that, right? So the most important thing that I found is be patient. Market turns usually take longer than we expect. That's, I believe, one of the big mistakes that I made in the stock market this year is I was right to sell when I did, but I bought back in way too early. And I think that's somewhat my personality, is that, okay, like the pain happened, we were right, let's get back in. Oh, crap, nope, it's actually still got another leg down to go, right? That is a mistake. And that's the kind of mistake I really don't want to make in real estate, and I don't expect to. The beautiful thing about real estate, though, where you can really minimize the risk of these sorts of mistakes, is the following. Okay, well, I'd like to do picture-in-picture here. Oh, no, yep, there's that, and then look at that. There we go. Okay, picture-in-picture on the mobile studio works. Okay, all right, so what I really want to do is I want to be in a situation where if we do get this sort of market dip, we're not necessarily trying to be perfect and buy everything here, because the danger of trying to buy everything right at the bottom is now you've got to rent out all these properties and you got to remodel all these properties, right? So we really want to go shopping all around this area, around sort of the bottom. And we expect that sort of bottom in the market to really last for years. And that's really a change from what we've expected, from the pandemic, what we got used to in the pandemic. In the pandemic, you really had the Larry Kudlow V-shaped recovery, where the market crashed and then interest rates were cut to zero and housing boomed within 2 months. It was remarkable. I remember on a daily basis in March and April, and you can go back and look at these videos from 2020 and look at the comments. The comments are brilliant. Look back at these videos, and we see, oh my gosh, week after week, I'm like, this is weird. Prices aren't going down. Inventory is going down. Prices are trending up. It's time to buy. And so what I did when I saw the signals that we were actually at the bottom of the market is I bought as much as I could without overextending myself. I bought 8 properties myself within the span of the next 3 months, March to like August. And that was remarkable because I was buying before the market really started zooming at the end of 2020 and the beginning of 2021. And that's what I want to do as well with HouseHack. Now, that recovery was very fast, and we were right to move as quickly as possible because rates got slashed so quickly. But the longer we just stay at, Fed funds rate of 4.5%, and then we pause and we don't go down for over a year, and then maybe we go down 0.25%, this could be a years-long process. So we have a lot of time. And that means we have to be very patient with HouseHack. Now, that is an opportunity because it gives us more time to buy the dip with less competition from first-time homebuyers. Why? Because lending standards tighten. When lending standards tighten and people have less disposable income, because if you're not already a homebuyer, you generally have less equity in these sorts of situations because you don't own real estate, and it's harder for you to get in. Lending standards, again, are tighter. We're going to be able to buy cash and refinance in the future. And so our goal now is let's raise the funding that we can over the next year, but we are in no rush to buy real estate right now. The beautiful thing about that is we're operating this company extremely lean. In fact, we technically have nobody on payroll right now. Now, that doesn't mean we don't have some expenses. We have some tiny expenses. But I'll give you a breakdown just in full transparency as to how this is working, and then we'll talk about the good and bad and everything. So what we've got is obviously myself and Lauren. We're not taking any kind of salary, but we'll be compensated with stock-based compensation in the future. Once we'll have some kind of stock-based comp plan that's very reasonable, probably like Elon Musk-ish, really designed to make sure that investors are getting some kind of very good return, knock on wood, before we even get any money or even have the opportunity to sell after an IPO or whatever. We'll have really strong lockup. So we never want my reputation to be like, oh, Kevin's 35, he IPO'd a company and he burned his investors or something like that. I'll never be able to raise money again. That would be very, very stupid, right? We can't do that. And of course, we've got a board of directors as well, making sure that everything we do is extremely reasonable. And so the beautiful thing about our payroll is the following. So we've got myself and Lauren. We're free with payroll, but again, we're going to have equity in the future. And then, of course, whatever we buy in now. We've got a construction manager. Right now, we're not doing any construction at HouseHack. And the beautiful thing about this is, so we've got a really great construction manager. I mean, phenomenal. We've really got two amazing construction managers. They know my formula. They could go into a house and remodel it the Kevin rental way, and it's safe, it's to code or above code, and it's a great property that we could rent out easily to a long-term tenant or a short-term tenant, whatever we want to do to maximize cash flow. It's another risk factor we're seeing, by the way, right now is in a lot of the markets I'm visiting, including where I am now. I'm seeing a large increase in the number of Airbnbs available, but not getting rented. This is a red flag, a big red flag. Probably as more hotels have occupancy and more business travelers are just using the convenience of a hotel over dealing with the potential risk or hassle of an Airbnb, because Airbnb landlords are so generally non-standardized in the service they provide. Anyway, those are opportunities, by the way, for HouseHack as well for improvement. So as our construction manager, and really two construction managers, we've got this phenomenal staff of 4 people. 2 managers and 2 workers. And of course, the managers are working managers as well. It's not like you're just standing around watching 2 people, right? That'd be crazy. But they cost HouseHack nothing right now, but we have them. They're kind of like ammo in your weapons satchel, ready to go. We're like, ready. We're ready. But they don't cost us anything. We kind of have them reserved. How do we do that? Well, we do that because I personally have 2 rental properties left. That's all I've got. I've sold 85% of my properties this year, all at the beginning of the year. The 2 properties we have is one of them finally got approved. We're going to turn a 3-unit apartment building into 6. That's going to be dope. That's going to be amazing. And I'll show you some of the progress of that in separate videos. Then we're going to turn a single family into 2 units, potentially 3 units, but we don't have the permit for the 3rd yet. We do have the permit for the 2nd. So we've got 6 months of work, if not more, for those individuals. And the cool thing is I can really finesse that, because I could say, hey, looks like, we're going to be buying sooner than expected. Let's start subbing out to more contractors rather than doing stuff ourselves. If we need them to be busy for longer, let's do more ourselves and sub out less. I guess we're painting instead of hiring the painter, right? So we have this flexibility with these projects, which are big structural remodels, which actually is really, really cool, because HouseHack pays 0 to have the benefit of these people eventually coming to HouseHack payroll, and they're already trained or getting better by the day for HouseHack. Like, they're going to be our coordinating staff for HouseHack. We're not going to do a lot of work ourselves for HouseHack. I want to be clear about that. We're going to be subbing out most things for HouseHack, because when we buy homes, we're going to be buying homes quickly. We can't go do everything. I mean, if it's something quick, like, oh, install a light fixture, fine, you may as well do that before you try to go sub it out to somebody else. But otherwise, most things will be subbed out in the markets that we're buying in, and people will be assigned to the different markets that we're buying in, since we're going to be diversified. And I'm going to be there a lot in all of the different markets. It's going to be a lot of traveling. But then, so we've got those 4 people that basically cost HouseHack nothing. Then we've got a COO of really all of my companies, which is great because the other companies mostly pay for this person, minus a small contribution that HouseHack makes to their salary. And they're phenomenal because they really came into sort of my life with like no experience. And what's so great about that is they've learned to be almost this replica of Kevin over the last nearly year that they've been working for me. And so now, as they've started working on HouseHack things, they do some things better than I do, just because they've taken everything I do and then they try to improve on it. Like, they're a real self-starter, real learner. And it's really great because, look, there's always the benefit of having somebody with a lot of experience, but then you also want people with almost no experience, so that way you could kind of teach them to do things your way, and then work with you on learning and perfecting those. Really incredible. So what's awesome is, I've got multiple companies. I've got a registered investment advising company, the education company, that's YouTube and courses, link down below. And then, of course, we've got HouseHack. And so they can spread themselves over all of those. And if, let's say, my education company and the registered investment advising company, those pay most of the salaries, and it's nominal what HouseHack has to pay. So it's really, really great. Then we've got 2 contractors. It's sort of our CFA staff, or CFO staff, I should say. CFO staff bundle. And it's really 2 for the price of 1. Really, really phenomenal CPA staff. Over 40 years of experience running a CPA practice. Second person has over 20 years of doing investor relations for a real estate company. Extremely detail-oriented. Like, they work together closely with my COO. And so we've got a really, really great staff here. But they also do work on, like, my books or filings for the registered investment company, for my education company. So again, sharing in the cost. That's less basically burn that we have for HouseHack. It's really, really cool because we're lowering our costs for HouseHack to virtually almost like no burn, which is really, really cool because, again, myself and Lauren, no payroll. We're compensated by YouTube and course sales. The CEO would be like, maybe a third of their payroll, and the same thing for the CFO folks, be a third, which is phenomenal. Like, this is so great. And so then, and then again, the construction managers are being paid 0 in the construction folks by HouseHack because they're not working for HouseHack right now. So really, really incredible system going on. Now, we did have to, and then we have a third-party CMO, like a marketing officer as well. But they also work for all 3 companies. It's so phenomenal. But we did unfortunately have to let one, and they're only, the CMO's compensation, the only compensation we're expecting them to get is a stock-based comp. So they're not even costing us payroll. Now, in the future, like post-IPO, that'll be a cost. But, I mean, it'd be so worth it for the company. Anyway, we did have to let one person go. And, I really believe in the phrase, hire slow, fire fast. Unfortunately, I'm just going to give you a few examples of really what it takes to be let go. When I hire you on day 1, I give you a list and I tell you, look, the most important thing to do is make sure these 20 bills are paid. That is your one responsibility. I don't care what you have to do. I don't care if you have to climb Mount Everest. You make sure those bills are paid. Because if they're not, you mess up my credit score. You mess up my credit score, now it makes it harder for me to personally guarantee real estate. And that creates problems. And so this is these expectations are very, very clear. And unfortunately, there are just sometimes people whom you might assign to a task, like, hey, your task is to create a new receipt system to make sure we're like perfectly ready for an audit. Because at some point in the future, there's always going to be an audit. In fact, when we go through the Reg A process, there are going to be audits. And that's good because it's good for investor transparency. But you have to actually be prepared for those. And it's easier to prepare for audits when you actually deal with the receipts as you get your receipts rather than trying to go find them all after the fact. That's terrible, right? So we're like, hey, why don't you, since you're in charge of the receipt system and bills, why don't you make sure you've got very strong system going on, and let us know how it is in a week from now. And then a week later, it's like, how's your receipt system going? Oh, I asked the other person to send me some receipts, but they never did. I'm like, dude, I don't care what you need to do. If you need to drive over there, go get the receipts. You make sure you get the receipts. It's very simple. And we're giving you the autonomy. Like, we're not micromanaging. We're giving you the autonomy to figure it out. But this is your job. Your job is making sure you figure it out and don't miss payments on those bills. A week later, we get a late on a bill on one of my personal bills, so it doesn't really affect anything. It didn't affect my credit either, which is fine. But I'm like, what? How are we late on a water bill? And how's your receipt system? I still haven't gotten any receipts. What are you doing? Bye. So that's not the kind of person you want at a company, because then it also sets a bad standard for your CMO, your COO, your CFO. Now all of a sudden other people are like, what? How is that person here getting paid, right? Now that person didn't get compensated by HouseHack one dime, so it's not like a cost to HouseHack, which is good. So, but it, I mean, that's just the nature of having a business, right? So really, we've got this fractional payroll, and the beautiful thing is we're going to be putting a lot of the cash that we have into treasury soon, once we get to 25 million in wires. Now, this is where a little bit I want to be transparent with some of the things that have come up. September was really great. We launched somewhere around September 10th, I think it was, something like that. And we raised over $1 million a day in commitments. And now we're at about 29 million in commitments. We're almost at 25 million in wires, which is great, because once we unlock the 25 million wires, we're going to be able to park that money into 6 to 12 month treasuries. We can't do it until we hit 25 million in wires, because that's what we committed to people in the purchase or the private placement memorandum at househack.com. You could read that, and you can join the investment there, and you get founder shares. Remember, there's no dilution. You up front, you get founding shares in the company, so you get the same sort of shares that I get that I'm buying. I'm almost in $1 million myself, and that's going to grow as time goes on here. And again, in the future, and this is the beautiful thing I think about this company, and it's all being based on why I want to make sure early investors are so well rewarded, because my reputation's on this, right? I want early investors to be like, oh my gosh, I can't believe I made so much money with Kevin. I wish I invested more. So that way, when in the future I'm like, hey, I got another, fundraise for HouseHack or whatever, people are like, yes. Like, I don't even need to know why or what, just yes. Like, that's the goal in the future, right? So I really have to take care of these first people, and that's why we're doing founder shares, no dilution up front. And we'll talk about it on non-accredited investors in just a moment. And again, the only dilution will be in the future after IPO, with strict lockup, some form of stock-based comp. But again, I say that not like it's dilutive to today's valuation, because it's not, because every company has stock-based comp. So, it's like they're two separate things. But anyway, I know that's confusing for some folks, but dilution is really a toxic thing. I mean, people raise, things at $1 billion. I think like Boxable is like a $2 or $3 billion valuation, but they've raised like $200 million. I'm like, oh my gosh, the poor investors who are going into that are getting diluted so terribly. But that's the way it works. Anyway, so the problem that's come up is we have these deadlines. At the end of each month, we have a deadline in terms of how much in basically call options you get. So here's how that works. They're technically called warrants, because call options are on the market, warrants are done with the company. If you invest $100,000 into HouseHack by October 31st and you're a course member, at some point in the future, probably in like 2024, we can call you up and go, hey, you can contribute another 60% or $60,000 in that case at the day one valuation. So that means we're already buying real estate. We already have rental properties. Our valuation is going to be higher, but you can contribute another 60 grand at the day one valuation. Now, some folks are like, wait a minute, Kevin, isn't that dilutive? Technically, no, because, for example, if you contributed $1 million and we raised $100 million, you have a 1% ownership of $100 million or $1 million. If we then raise an extra $50 million, well, then technically your ownership share goes down to like 0.67%, but that still represents $1 million in value, right? 0.67% times 150, it's still going to be $1 million. And that's the beautiful thing about this. Just do a quick little fact check on my math there. 1 million divided by 150 million, yeah, 0.67 exactly. So the cool thing about that, though, is it gives HouseHack another opportunity to raise more cash so we can go buy more deals at what we think will still be the bottom of the market. And it again rewards early investors. And so we have a deadline at the end of every single month. At the end of September, we had a deadline where you could get up to 65% of these warrants options, basically. And they're free, right? They don't cost you anything to have these, which is great. 60% at the end of October 31st. So as long as you sign your subscription agreement by the end of October 31st and you wire by the end of the first business week of November, you're in at 60%. If you wire by the end of December, by the end of November 30th, that would be. If you sign by the end of November, it'll be down another 10%. By December, the end of December, it'll be down another 10%. And probably by the time we do the non-accredited round, the opportunity to get warrants will be pretty low or zero. But at this point, it looks like, because the process for non-accredited investors is going relatively fast, it looks like we might be able to get non-accredited investors in at the founder valuation. The minimum investment for non-accredited investors will probably be $20,000 unless you're a course member, and then the minimum investment will be $5,000. That's what we're tentatively writing, which is really cool. So that way you don't have to be accredited. But obviously, if you're accredited and you sign now, you get more options. So it all sort of depends on when that the SEC approves our non-accredited round. But we're working on that. And so the goal really is, the downside. The downside is we had a really great run going up to the end of September because the people who wanted to invested to get those options. But it's really slowed down in October. And that's, I think, because we kind of hit a pull forward. A pull forward is kind of like when you have a Black Friday sales event and so many people buy or so many people fund, right? Then like the first couple weeks of December, your sales are like really low because everybody who was going to buy already did during that sale. And it's like the pull forward is like a painful moment. Kind of like a pull forward that you see with like solar panels right before December 31st. Everybody wants to spend their money to get their tax credit right before the end of the year, and then sales plummet in January. Super, super typical. We're feeling that right now, so additional commitments have slowed down a lot. Now, that's not necessarily a bad thing because the company is going to happen. Like, we will be having HouseHack. And it's actually, it almost makes it easier for me to have less money because I feel like I can, and no guarantees, okay? I'm just hypothetically speculating here. If I have 25 or 30, let's say I have $30 million, right? And it gives me about $100 million of purchasing power for real estate. I could probably, 5x the value of that company quicker than I could 5x the value of the company if I had, $500 million and of cash and maybe 1.5 or closer to $2 billion of purchasing power, just because it's going to take longer to get that much kind of staff. I personally think a real good target though for us by March is to be really somewhere around $50 to $150 million raised. So for example, if we get to $75 million by, let's say, February 28th, and then we do our non-accredited round and we do another 75, that's 150. That's good. We don't need more than that. But the company is viable already at $30 million, which is roughly the amount of commitments we have. So we're viable. We're great. And we're just in we just passed our first month of fundraising. But that does mean there is a deadline coming up here at the end of October for if you're an investor and you want to come in, now's the time to get your letter from househack.investready.com, get your accredited investor letter, and sign the subscription agreement. If you have questions, email us at ir@househack.com and join. If you're non-accredited, stand by for the beginning of next year, which will be very exciting. And we're super excited. It's everything is honestly going way better than I expected. And if you think about it, we're like at the bottom of the market. I have a lot of investors sending us emails and stuff saying, look, dude, Tesla stock is down right now. we're just going to wait until Tesla stock is up more, and we'll just have to sit out on some of those options. So, I mean, we have multi-millions of dollars of commitments from Tesla investors, but they're like, we're just going to wait a little bit for Tesla to rebound a little bit or have a euphoric rally or something. I don't blame them. Anyway, go to househack.investready.com to get accredited. Go to househack.com to upload your letter. And folks, hope you appreciated the update. Leave questions in Discord at metkevin.com/chat, and I'll personally reply under the Seed Company Discord channels. Thanks. Bye.